Welcome to the deep dive. Today, we're cutting through the noise, diving straight into some really key financial news. We're zooming in on Tata Communications and their Q1 FY26 results, which just came out. They're a huge player in the global digital space.
Absolutely. And our mission today really is to pull out the most important insights. We've got their official review docs, the press release, some analyst questions too. We want to help you understand what these numbers actually mean for the company's performance, where they're headed strategically, without getting bogged down in all the jargon.
Exactly. We'll be your guides, basically, sifting through the data to give you the real nuggets, the so what behind it all. So let's jump in. The big picture. Q1 FY26. That's the quarter ending June 30th, 2025. Okay, so headlines first. On the surface, Tata Communications, they saw some pretty healthy revenue growth. Their total sales, what they brought in, went up by a solid 6.6% compared to last year.
Yeah, that's a strong top-line number, almost 6,000 core. It definitely signals they're expanding, getting traction.
But, and this is where it gets interesting, while sales were up, their actual profit, the profit after tax, or PT, from their main ongoing business, well, it dropped a lot, down almost 35% year over year, landed at just 232 crore.
That's a really significant hit to the bottom line. And it shrinks their profit margin quite dramatically, from over 6% down to under 4%.
And even the operational profit measure, EBITDA, that stayed flat compared to last year, around 11,137 crore, which means effectively the margin there also tightened from about 20.3% down to 19.1%.
You see it in the earnings per share too, the basic EPS. That also dropped quite a bit, from 11.68 down to 6.67.
Okay, so this is the real head scratcher, right? Revenue's growing nicely, but profits and margins are falling. What's driving that? What's really going on behind these numbers?
Well, my first thought immediately goes to sort of the one-off events. We often see companies have these unusual quarters, and Tata Comms is no different here. The first thing to unpack are what they call exceptional items. In this quarter, Q1 FY26, they booked a charge of about 20.44 crore for staff cost optimization.
Okay, so that's like restructuring costs,
It did.
tidying up the organization.
Exactly. It's tied to making organizational changes, maybe removing some redundant roles, all aimed at making things more efficient in the long run. But it does hit the profit number this quarter.
Right. Makes sense for the future, but hurts now.
And here's the really critical piece of context. The results from the previous financial year, particularly Q4 of FY25, included some really big one-time gains, things that aren't happening every quarter. Like they made nearly 660 core from selling properties back then.
Ah, okay.
This Q1 didn't have any similar huge gains like that. So when you compare this quarter's profit directly to last year's Q1, which followed that big Q4 gain period, the drop looks, well, much steeper than if you were comparing just the regular ongoing business performance.
Gotcha. So it's like comparing your salary this month to last month when you also got a massive one-time bonus. It really skews the picture.
Precisely that. And beyond those exceptional items, there were also some structural changes, divestments, that played a role in the consolidated profit number. Back in April 2025, one of their foreign subsidiaries, part of Data Services, issued new shares to venture capitalists.
Okay.
That diluted Tata Communications' own stake down to just under 11.5%. So
Yeah.
they lost overall control of that subsidiary.
And that resulted in a loss, even though they didn't sell anything.
Yes, but it was a non-cash loss of about 42 crore this quarter. It's purely an accounting thing.
Hmm.
It happens because they had to reclassify some foreign currency translation reserves. Think of it like money held overseas in a different currency. If the exchange rate moves against you, the value on your books here can drop, even if the actual foreign cash amount hasn't changed. It's an accounting adjustment, not an operational loss.
Okay, that helps make sense of it. It's not like they lost cash out the door. And didn't they also sell off their payment solutions business, TCPSL? I remember that happening earlier.
They did, yes. Back in February 2025, they sold their entire stake. And that did generate a significant gain over 311 crore. But, and this is key, that gain was booked in a prior financial period. So it added zero to the profits in this Q1 FY26 we're looking at now.
Right, so another reason why the direct year-on-year profit comparison looks so rough.
Exactly. It just further underlines why you have to look past the headline profit drop and understand these specific items.
So putting all these pieces together, the one-off restructuring costs, the lack of huge property gains this time, these accounting effects from divestments, what does it tell us about the sort of the core health of the business? Does it maybe suggest the ongoing operations are actually more stable than that big 35% PAT drop implies?
I think it absolutely does. It really highlights why you need to dig into the details, look beyond the headlines. It also signals, a bit of strategic housekeeping. They seem to be shedding some legacy assets, streamlining costs. That can be painful short term, obviously impacts the numbers now. But the idea is it frees up capital and management focus for the future.
Yeah, focusing the business on where they see growth, less about maximizing this quarter's profit, maybe,
Hmm.
and more about shaping the business for the next few years.
Precisely. A strategic repositioning.
Okay, so speaking of strategy and where the focus is, let's break down how the different parts of their business actually performed. Where is the growth and where are things changing? Data services, for example, that's still their main revenue driver, right? Showed really strong growth, 9.4% year over year, pulled in what, 5,130 crore? Mostly from this digital fabric stuff. Sounds great.
It does sound great on the revenue side. But here's the catch. Despite that revenue jump in data services, the actual profit from the segment result, it went down compared to last year. Dropped from about 330 crore to 239 crore.
Whoa, okay. So pulling in more money, but making less profit in their biggest, most important segment. That definitely raises a question. What could be behind that? Are they maybe cutting prices to grab market share or investing really heavily in new tech or infrastructure that hasn't paid off yet?
It's very likely a combination of factors. Often in these rapidly growing digital areas like their digital fabric, companies reinvest a lot back into the business. They might be sacrificing some short-term segment profit margin to build scale, develop new capabilities, expand the network, maybe even acquire new customers with initial lower margins. It's a common strategic play for long-term dominance.
Okay, that makes sense. So strategic trade-off. Invest now for future gains. Now, somewhere things looked more straightforwardly positive was the campaign registry segment. That showed strong growth in both revenue and profit year over year.
Yeah, revenue up to about 189 crore, and the profit from it, the segment result, climbed nicely to almost 123 crore. So that's a clear positive story there.
Definitely a win. And interestingly, connecting back to that efficiency idea we talked about, transformation services. Revenue there actually went down a bit year over year, but the profit from that segment jumped significantly.
That's right. Segment result went from about 19 crore last year to over 43 crore this year. That really points towards improved operational efficiency in that part of the business. They're managing to make more profit, even with slightly less revenue coming in the door. Doing more with less, essentially.
Which is always good to see. And then, as you probably expect, the more traditional areas like voice solutions and real estate, those continue to see declines in both revenue and profit compared to last year.
Yeah, the trend there continues. So if you look across all these segments, what does it tell you about their strategy? It seems pretty clear they're heavily focused on investing in and growing these newer digital areas, data services, campaign registry, while actively managing, maybe even phasing down, the more traditional, perhaps less profitable streams like voice.
It's that classic portfolio management, isn't it? Pruning the old branches to let the new ones grow stronger. Rebalancing act.
A continuous process of reshaping the business for where the market is going.
Absolutely. But it's one thing for us to interpret the numbers. What are the leaders at Tata Communications saying? How do they frame this quarter in their vision?
Well, the MD and CEO, Mr. Lakshman Narayan, he talked stable performance. He highlighted healthy double-digit growth in our order book, which is always a good sign for future revenue. And he really emphasized how their digital fabric is becoming deeply embedded in what their enterprise customers do. So confidence in that core strategy.
Okay, positive message there. And the CFO.
The CFO, Kabir Ahmed Shakir, he echoed that, said he was encouraged by the narrowing losses in our digital portfolio. So seeing improvement there. And he also mentioned adding multiple million-dollar deals to their order book just this quarter. Again, pointing towards future business pipeline building up.
Good momentum signs then. And have they made any other big strategic moves recently, beyond just the numbers?
Yes, a few key things. The board gave the green light to raise up to 1,000 crore by issuing non-convertible debentures, NCDs, through a private placement. So, securing more capital, presumably for future investments or projects.
Fueling the growth engine?
Seems like it.
Yeah.
And they also approved buying shares within their own group, acquiring Solutions Infinity Technologies, SI India, for about 124 crore. The stated aim there is to simplify their overall group structure and get more direct control over enterprise messaging services, which fits right into their digital offerings.
Makes sense. Tightening control over core areas. Anything else on the innovation or expansion front?
Yeah, they announced a new subsea cable system aimed at boosting next-generation global connectivity. That's core infrastructure for them. And interestingly, they also mentioned plans to expand their work in global live sports broadcasting, taking that expertise into more regional markets. So looking for growth beyond just the typical enterprise deals.
And it seems the market is noticing these efforts, right? They got some awards recognition.
They did. Notably, Gartner named them a leader in the Magic Quadrant for Network Services Global for the 12th year running. That's quite a streak. Plus a bunch of awards for specific digital fabric solutions, things like Safe Passage Security, their cybersecurity services, contact center solutions, CKIS, CPIS, even eSIM technology. So lots of external validation.
Okay, so lots of positive strategic momentum, management confidence, market recognition. But there's always a but, isn't there? How does all this ambition square with those significant contingent liabilities we touched on earlier, those big potential payouts hanging over them?
That is the crucial question, isn't it? It's a major balancing act. On one hand, driving growth. On the other, managing risk. The big one is still the demand notices from the Department of Telecommunications, the DOT, totaling a massive euro 7,827 crore across different years.
Wow, that's
Yeah.
huge.
It is. Now, they classify most of it, about 7,500 crore, as a contingent liability, meaning they think it's possible but not probable they'll have to pay,
Yeah.
or the amount isn't certain yet. They state quite clearly that they believe they have strong grounds to appeal and defend their position on these demands. But still, it's a very large number looming.
Are there any other significant ones?
There's also a foreign VAT assessment value-added tax for about 338 crore related to operations in Europe. That's also classified as a contingent liability while it's under appeal.
Mm.
So you have this interesting dynamic, investing heavily in the future, simplifying the business, winning deals, but also facing these substantial potential financial headwinds from past issues or regulatory disputes. Navigating that is key.
Right. So as we wrap up this deep dive then, it's been quite a picture for Tata Communications in Q1. We've seen, solid growth on the revenue side, a very clear strategic push towards their digital fabric and enterprise solutions. But yeah, a complicated profit story, mainly due to those one-offs and divestments.
And hovering over it all, those significant contingent liabilities, especially the DOT demands, it really paints a picture of a company in transition, driving hard on its digital future while managing some considerable legacy risks.
Absolutely. So maybe the final thought to leave you, our listener, with is this. As Tata Communications keeps pushing its digital transformation, expanding globally, how will they effectively balance these ambitious growth plans and the needed investments against those very large financial uncertainties, particularly those huge DOT demands? What kind of steps might we see next from them to try and secure both innovation and long-term financial stability? Something to watch.